And as a consequence of that, I think the gold trade on the basis risk to reward is the best trade I see. I would say on a risk versus reward basis that the best place to be is probably in the gold trade. It's unusual from my point of view to find high quality gold companies, irrespective of market cap, that is to say, the best of the best or the best of the juniors, priced reasonably. And I see them being priced reasonably. I'm not trying to say that the biggest gains that you can harvest will be in the gold sector, but if you juxtapose risk to reward, and if you look at the valuations of the good companies in the sector relative to their historic norms, when I say price versus value, I'm really talking about enterprise value versus net present value. Uh, that sector seems attractive to me. The sector, too, has, pardon the pun, but lost its luster. The US dollar has been quite strong post Trump's election. And there seems to be euphoria in the United States that the Department of Government Efficiency, led by a person who became a billionaire on subsidies, is going to do some spectacular job um, reducing the size of the US government. I think that's utter fiction. I don't think that we'll run out of that perception anytime soon, which is to say, I don't think that you're going to see a panic into gold anytime soon. But I do think that the overall arithmetic of the maintenance of purchasing power in the US dollar uh, is going to continue is silly. I think the dollar will do well compared to other basket case currencies, your own included. I think the dollar will do well against the euro. I think it'll do well against the Swiss franc. I do think it'll do well against the British pound, the Canadian dollar, the Australian dollar, all of that. I don't think that we will maintain purchasing power in the US dollar. And as a consequence of that, I think the gold trade on the basis risk to reward is the best trade I see. Well, I've had some juniors in particular that have done too well, I think. They're beginning to be priced for perfection. And I don't want to name any names because they're old friends. But I had circumstances where I owned the stock because I thought I'd see 150% return, in 2 or 3 years. And I've seen that return in 2 years. And, when a stock meets my target, and where I see it at a premium, when I say a premium, when I see the enterprise value of the company being 160 or 170% of uh, what I consider to be its net present value, unless I see a really, truly spectacular uh, development pipeline, I try to switch from names that are fully valued to names that aren't fully valued. That's just sort of what I do. And I the junior silver sector, I remember on an interview with you probably a year ago, maybe longer, just saying I'm not making a silver call, but the junior silver stocks are widely, widely, widely reviled. I think I used the phrase coiled spring. And that negative sentiment got erased in a year. I had anticipated that either the silver price would increase, which it hasn't really, it's increased some, or that the silver stocks would claw back from the hate over 3 years. But they clawed back from the hate in 6 or 7 months. Well, let's start. Most of your listeners own no gold.
Mm.
So let's start at the top of the exercise. I realize as a young person that you're seduced by buying some stock at 20 cents that's going to go to $2, except it very, very, very seldom happens. So you need to consider the other part of your life, which is to say that part which is very likely to come true over time. In terms of the gold trade, I would start by owning gold. I suspect that most of your listeners save in euro. And saving in euro, except to maintain liquidity, is a fool's errand. Um, Looking at your future in the 10-year term and the 15-year term, which I realize is difficult to do in your 30s, and not saving in gold as opposed to saving in euros is simply foolish. Uh, and I'm not just picking on the euro. Saving in fiat currency denominated savings products is mathematically idiotic. The deterioration in the purchasing power of your currency relative to the interest rate that you receive in fiat denominated instruments was described, I think, by Hayek as a certificate of guaranteed confiscation. So start with gold. And then start with very high quality surrogates, which is to say Franco Nevada, Wheaton Precious, Agnico Eagle. Are those stocks cheap? They are not cheap. At the gold price, which I am afraid that we're going to see, however, they are reasonably priced, which they seldom are. Two, the very high quality companies always yield geological surprises, and those surprises are always good. And I like good as opposed to bad surprises. Those companies have corporate culture that means that their recycle ratio, which is to say the amount of resource that they can add to the balance sheet uh, relative to the margin that they get for selling existing ounces, is very strong. There's a virtuous circle in place that you don't see in the companies one category down. Now, it's much more fun to play at the bottom of the trough in the exploration sector. And I must say that all of the money that I now invest carefully, I made by speculating wildly. But your listeners need to understand that even in retirement, I spend 40 hours a week at that game. Most of your listeners, your age, have lives. You don't, but most of your listeners do have lives. And for them to feed at the bottom of the trough exposes them to more risk than they are willing to ameliorate through work.
For the record,
There's no escaping that conclusion. We can talk around it all day long, but there's absolutely no escaping that conclusion. The more work they're willing to do, the further down the trough they can come. But most people, A, want the reward without the risk, and B, they want the reward without the effort. You know, Antonio, I've graded now over 100,000 portfolios in 10 years. And I guess because of that, the information that I have with regards to mistakes that investors and speculators consistently make is very good. It's not grounded in narrative. It's grounded in by what is now a very, very, very large statistical sample. I think it's an opportunity. I would tell you, and this is very difficult to do, that you need to spend some time talking to the companies and learn to anticipate, at least on a probabilistic basis, how many mistakes they're going to make. Are they going to overpay? Are they going to construct a conservative financial stack that can survive an 18-month hiatus, or more importantly, survive a mistake? The point that you make is a good one. There is so much money now in passive ETFs that companies can enjoy a larger relative market cap simply by becoming larger and more liquid companies. This is as much mining financial markets as it is mining gold. But the truth is that that is a worthwhile endeavor if you have the skills. There are people out there who seem to grow for growth's sake, and that's okay if you're good at it. But the if you're good at it is a very, very important caveat. Much more intelligent, probably, are the companies like Agnico Eagle that grow strategically. Yes, they do mergers and acquisitions, but the mergers and acquisitions actually bring synergy, not mere size. They are good at constructing mines in northern climates. They understand the politics of Ontario and Quebec. They speak English and French with good affinity. They pay what would appear to be premium prices for deposits that are very proximal to their existing locations so that they take the capital cost out of the acquired projects. Compare that with nameless companies who simply engage in financial engineering with only moderate intelligence, demonstrating mostly leverage to the upside in the gold price, and they believe that their competence extends to 3 or 4 continents. In truth, there are some smaller companies that are great mine builders. I'm thinking Bema Gold, building and then selling mines in Nicaragua, building and operating mines in the Philippines, including doing during the Duterte era. Thus far, navigating uh, treacherous shoals, I would suggest, in Mali, operating well in Namibia. There are mid-tier companies that have proven themselves to be capable in the strategy that you're discussing, which is to say buy and build. But you have to be as particular in the buy and build category as you would be in the exploration category. There are people that have a track record of success in that activity and that have the correct corporate culture to carry on that activity. There are others, I'm afraid, that are merely LSE or TSE or ASX gangsters.